Hi, good evening, everyone, and thank you for joining in the call. Last few weeks have been extremely volatile for the market, and we thought it's a timely call looking at the markets, and we all keep wondering that is it a time whether we go risk on or risk off? And when I'm meeting across distributors, there are various opinions coming on the market. We thought we'll share our view on the market over here. So today on the call, we have Harshad Patwardhan, our Chief Investment Officer, and we have Sanjay Bimbalkar, like Head of Equity. And I'm Saurabh Jain, I head Sales, Product and Marketing at Union Mutual Fund. So we start the call with Harshad, who will talk about how he sees the market in the current scheme of things. And further to that, we'll take Q&A. And in the meantime, you have any questions, you can start typing it on the Q&A tab. We'll take all of them. Yeah. Over to you, Harshad.
Arshad, you're on mute.
Sorry about it. Hi, thank you, Saurabh, and good evening, everybody. Thanks a lot for joining on this call. So we will try to cover, our thoughts on the market maybe in the next 15-20 minutes. And I will really encourage you to ask any questions that you might have. Sanjay and I will try to answer as much as we can. So if you think about March 26, the last month was really brutal for Indian markets, not only for equities, for currency as well as for fixed income. The slide that you see here, if you look at on a INR basis, local currency basis, Indian market Nifty was down about 11%. We all know that. But just also look at the column left to that, which is Nifty was down 14.4% in US dollar terms. And in that particular column, if you look at MSCI India index down 14.5%, again underperforming the emerging market index. And all of us know, but just to put some numbers to it, if you look at 12-month basis, the third column, you will notice that emerging market index over the last 12 months did 27% in USD, where India was actually down 13%. So that highlights the extent of underperformance of India vis-a-vis emerging markets. I will not go into the reasons for that. We have talked about it before, but if there are any questions later, I will answer them. So if you look at the absolute performance in even INR, March 26, 11% down, that is the worst performance over the last, I would say, 5 years. Before that, clearly March 2020, we had the market falling by 23%, again in March 20. So a really brutal performance for equities. Clearly, we all know the trigger for that was what happened on Feb 28th when US and Israel attacked Iran. And what we have been seeing over the last few weeks was, we can call Gulf War 3, maybe. So that clearly was the reason. And because of which, can we go to the next slide, please? You see that oil prices in a month were up 79%. And we have consistently maintained in all our presentations in highlighting risk. We have said that the biggest risk for India, which unfortunately cannot be hedged, is if oil prices go up. And importantly, if they stay high for a long period of time. But 79% increase in oil price in a month was a very rude shock for Indian markets. And clearly that led to the panic reaction. Can we go to the next slide, please? And that led to, if you look at this particular graph, again, in all our presentations, this graph is always present. Just focus your attention on the orange bars. Orange bars are the ones for representing FPI flows. So you will notice that in March 26, these are secondary market flows, not total flows. Secondary market, FPI sold $14.6 billion. I was checking the numbers, and this is the worst ever number in the history of Indian markets, absolute number of $14.6 billion. If you go back and look at what was the outflow in March 2020, when the market fell by 22-23%, that number was $8.4 billion. So worst ever outflow that we saw from FPIs in the month of March. Clearly, because what was probably the worst nightmare for India, which is the Gulf War and oil prices going up, that actually manifested. Now, if you think about, is there any silver lining? Things look pretty bad. So I would say yes. There are two things that I would like to highlight, which are I can call silver lining. One clearly is valuation. Can we go to the next slide, please? So in this chart, this is the Sensex PE over last 30 plus years, how that had changed. So as a result of the brutal reaction in the market, what has happened is at the end of March 26, the valuations corrected to 1 year forward 17.6 times. And if you look at the long 30 plus years average, it's very close to that. So after a very long time, in fact, if you just glance at this chart, you will notice that the last time the valuations were at this level was exactly in March 2020, the pandemic fall. So so silver lining is that in the Indian context, generally I have found that valuations become reasonable or cheap only when there is a panic. And yes, as a result of this panic reaction, the valuations are at long-term trading average. More importantly, the orange line is 30-year average. But if you were to look at 10-year average, which many people will argue is more relevant rather than 30-year average, then actually the 10-year average is about 21.8 times 1 year forward. And at 17.6 times on a 10-year basis, the valuations are 2 standard deviation below the mean. So on a 10-year basis, I would say the valuations are really, really attractive. So valuation is definitely one silver lining. Can we go to the next slide, please? This slide explains, what is causing the market change. So if you look at this slide, focus your attention first on 1 month ago. So 1 month ago, on a 1 month basis, Nifty is down 11%. Earnings in the meantime were up 1%. So let's say it's going at 12% CAGR, and the valuations contracted from 19.2 to 17. This is Nifty. We were talking about Sensex earlier. And if you go to the next slide, this is something that we put in all our presentations on a fair value spectrum. Mind you, this is a 5-year view, but valuations are now in very attractive zone after a very, very long time. So essentially the point is that yes, it has been a brutal month, but valuations are now at a level which are, we can say that they are fairly compelling. We can go back to the first slide, Ninad. We won't be using the slides now. So that is one positive. The second positive clearly is the ceasefire that was agreed upon last week. And that has given a hint. And of course, there is more news flow overnight, which suggests that we are probably seeing the worst of this Gulf War 3. And that is another silver lining, clearly. Because if this ceasefire, two-week ceasefire, if that matures into a durable peace, then I think we are probably past the worst. And that is, very, very important. Now, if that were to happen, if you believe like we do, that we are probably past the worst, then I would argue that the valuations are so compelling that they have not been this compelling for a long, long time. So I would, encourage you to think about the markets in a positive way. It's not very often that you get 10% correction in a month, and that happens only in panic. So at this point of time, the worst thing anybody can do is to get paralyzed because of the fear of the unknown. Because valuations have corrected, the risk reward is looking very, very attractive. And the positives for Indian market, which we talked about in February, unfortunately, it was overtaken by these events in the Middle East. The positives which have come to the foreground after almost 18 months, I will just list them. So one is clearly the EPS growth pickup. Last 2 years, FY24 to 26, the EPS growth was very lackluster compared to long-term history. It was, less than 50% of the long-term CAGR of about 13-14%. We expect the next 2 years earnings growth to be significantly better, somewhere in the mid-teens. So that is, positive number one. The second positive is clearly, and again, that got lost in February, as you know, finally we had the US-India trade deal. And last 12 months, India had signed trade deals also with EU and UK, which will become effective sometime during this year. So the trade competitiveness, which was a big problem since July of last year, that has been taken care of. So going forward in the export market, India is now very competitive compared to the other peer countries. And thirdly, the policy actions that both Government of India and RBI have been taking over the last year, 15 months, in terms of tax cuts, GST cut, RBI reducing rates, reducing regulation in unsecured lending, and so on. Because of that, we believe that the consumption will get a boost, and also the social security measures taken by various state governments and central government. So these positives will now come to the foreground now that we have probably seen the worst of the Gulf War. And we believe that, in FPIs will start looking at favorably to the Indian markets. If you look at, another positive, I would say, is the initial conditions as far as how FPIs are or FIIs are positioned in India. Currently, FIIs are underweight on India compared to the relevant benchmark. And I will give you, some numbers which I've got from the broker. If you look at all active strategies, FII strategies, which includes global ex-USA, emerging market, global, and Asia ex-Japan, if you put it all together, active strategies, on a weighted average basis, the AUM is roughly about $1.4 trillion. And if you look at it, on a combined basis, foreigners are underweight to the extent of 200, 210 basis points at the end of February. In March, that number probably would have gone down further. So, good news is that in the beginning of it, which may be India, joining again in terms of emerging market performance, the starting point is that foreigners are very underweight in India. In fact, in one of the notes that I read, this is the biggest underweight on India from foreigners in the last 20 years. I would look at it as a positive that the initial conditions are favorable. So if foreigners do decide to come back to India, because now the relative attractiveness of India has improved, there is a lot of catch up for them to do even before they become neutral. And traditionally, foreigners, if you look at last 30, 35 years, have been generally neutral to overweight on India. So I would consider that as positive. And because of which we believe that, the risk, not only that the risk reward looks very attractive, we also believe that the rebound in the market is likely to be front-ended, which means that, if you share our views, it's important that you position correctly, because it is possible that, whatever returns we expect over the next 1-2 years, large part of the returns might come in the first few months and quarters. So it's very important to position your portfolios accordingly. So I would argue that it's very risky at this stage to be underweight on Indian equities. Indian equities have done very badly. I agree, over the last 18-19 months since September 24. But now the risk reward is looking really compelling. It's very important that you work with your investors to position their portfolios correctly. Because the war is not yet over officially, and there can be surprises, we would recommend doing maybe 3-month STPs in diversified equity funds, funds such as multi-cap, flexi-cap, large and mid-cap. Of course, SIPs can, of course, continue in small cap, mid-cap, innovation kind of strategies. Also, for our partners and their clients who have higher risk appetite, I would also, recommend looking at our active momentum strategy. If you want to catch the rebound early, that is another strategy that you can look at. Maybe what I will do is I will take a pause here, and I'm sure there are questions, many questions. Saurabh, Sanjay, if you want to add anything before we go to Q&A, please feel free.
No, nothing.
So, Harshad, is it okay if we move to Q&A? There are quite a few of them.
Sure, of course.
Yeah. So the first question is on the earnings side. Harshad, you spoke about that your 25-26 was muted in earnings, going at 50% of the historical range. And we're expecting the next 2 years to be at mid-teens. Do you think there will be some downgrade because of the war? Because IMF came out with this some report that the whole world may go into a recession because of the war. Do you also see earnings coming down, this mid-teen coming down because of war?
It is possible. I think a lot will depend on how quickly the war ends. So if let's say the war ends in the next few weeks, then the impact will not be huge. But I agree that because of the damage that has happened to the infrastructure in the Persian Gulf to petrochemical plants, refining plants, gas, etc., it's fair to say that the energy prices over the next year will remain high, even when the war gets over, will remain higher than before. So to that extent, there will be some downgrades in select companies. But remember, when we are looking at the market as a whole, index as a whole, or when we are building portfolios, there will also be upgrades in certain sectors. So accordingly, we will have to tweak our portfolios to take care of that. But as a broader point, I agree that there could be some pressure on earnings estimates of certain sectors, but there may be some compensation that will happen from some other sectors.
And you think that the like next question is on USD INR. Do you think that INR will revert back to the original level once this war is over, or this is a new normal for the INR?
So, clearly, if the energy prices are going to stay higher over the next year, even if the war gets over, tonight, will mean that there will be some pressure on INR. Clearly, the exaggerated reaction that we saw in the month of March was because of the speculation in the market, and as all of us know, RBI has taken certain steps to reduce that particular speculative element. So I would say that uh, the dramatic action that you saw in INR USD probably will not happen, but I think the tendency will still be for rupee to continue to depreciate, maybe at a lower rate than before compared to USD.
Thanks, Harshad. One of the MFD partners have asked us to share the slides. We will do that after the call, but also just to inform you, the outlook, state of the market and outlook is uploaded on the website every month. And the people who are on the call will be sharing the link on the website. So every month by say 7th to 10th of the month, we upload our monthly update on the state of the market. Uh, when the war broke out, so this question is regarding the portfolios that we run. Did we do any drastic sector change and change our sectoral positions because of the war?
So I will, answer this question briefly, but I will, request Sanjay to talk a little bit more about it. See, firstly, the war happened, and the action that we saw is that 11% down. That is at the Nifty level, right? Individual stocks corrected much more. The stocks that are directly impacted. So there was not a lot of time actually to change the portfolios. Also, the critical thing, when the war was on full on and before ceasefire, the critical question that was bothering everybody is the duration of the conflict. So it was very clear. So what we had done is that we had obviously done an analysis as to which are the gainers and losers from this. But the prices had adjusted, almost immediately. But we clearly knew that if this war goes on for a long time, then what make changes to make to the portfolio. I will, request Sanjay to add if he wants to add.
Yeah, thanks. Thanks, Harshad. As Harshad was alluding, there were some sectors where impact was clear, and there were many sectors where impact is still unclear. As we discussed in our Outlook presentation as well, the second order implications of this war are still unclear, and that is where majority of our efforts are also going to understand what will be the second order implications. So just to give you a perspective, let's say if you look at the oil and gas sector, and if you drill down into various assets like oil, gas, or refining or transportation linked sectors, there were clear negative implications because of these oil prices. And that's where it was very easy to take action and understand what are the implications. And that's where we took some actions. But as Harshad alluded, majority of the second order implications, particularly if you look at unavailability of gas, or if you look at unavailability of oil, and how that will unroll, those needs to be clearly understood, and accordingly some nuanced actions were taken in the portfolios. But majority, there is not a drastic action, or there is no knee-jerk reaction which we have taken into portfolios.
Uh, any Can you also give, so one quick question is, can you also list out the current overweight sectors and underweight sectors across all our portfolios?
Sanjay, you want to take this?
Sure, sure. So our approach is actually mix of top-down as well as bottom-up approach when we are acting on the portfolios. So current overweight sectors, we find sectors like financials or capital good industrial to be at a significant inflection point and positive. And those are the two main sectors where we are significantly positively positioned across portfolios. Another area which we have found out which will get positively impacted over a period of time is consumer discretionary because of the GST cuts as well as the upcoming Eighth Pay Commission, which we have talked about in past as well. So those are the three areas where we are positively positioned. We have cut our underweight in IT mainly because of the valuation call. That valuation of IT companies corrected significantly, and that underweight call has played out to our favor, and that is the area where we cut our underweight position. Current underweights in the portfolio are sectors like FMCG, energy, regulated utilities, and some segments of materials, because we believe that unavailability of oil and gas and its second order implications on fertilizers and many other chemicals may be severe, and those are the areas which we are cautious on.
Thanks, Sanjay. Harshad, you talked about coming into the market by STP or SIPs. So if lump sum is there, you have suggested a 3-month STP, which I'm sure, if you do a longer duration STP, then probably you will be buying at a highs if this war ends quickly. So the follow-up question on that is, if we have to look at Union Mutual Fund and we want to look at pure equity funds for doing lump sums or STP, lump sum via STP, and the horizon is 5-year plus. So what are the products that we should be looking at? If you can name 4, 5 products that we should be focusing on from Union Mutual Fund. That's a distributor partner asking the question.
Okay. So firstly, before I get there, and Saurabh, feel free to add to that. When I say STP is because we don't know whether the war is going to get over. If somebody tells me or somebody guarantees that the war is getting over tonight, I will say do lump sum. The STP argument is because we don't know. So in that case, even if you start a 3-month STP and war gets over next week, then I would recommend that you should prepone all your remaining installments of STP immediately. Because I do believe strongly that the recovery in the markets is likely to be front-ended. And therefore, the questioner is exactly right that if the market is going to rebound from here, so once that event risk is out of the way, one should go lump sum. So STP is in the context of because the war is not yet officially over. That is point number one. Secondly, as I said, that which funds you play through is a function of the risk appetite of the your end investor. If the risk appetite is high, I would say that active momentum fund is a good idea to think about. As I said before, even through this, nobody should have stopped SIPs into small cap, mid cap, innovation, because these are the categories that actually benefit from higher volatility. But for lump sum and STPs, as I said in the beginning, uh, diversified schemes where you have a representation of large cap, mid cap, small cap, so such as multi cap, flexi cap, large and mid. These are the three schemes that I would recommend, and the reason for that is that in my hypothesis, I do believe that FPIs, after a very very long time of staying away from India, will likely come back to India. By the way, in 2025, they've already started putting money in emerging markets as a whole. The biggest beneficiaries in 2025 clearly were Korea, Taiwan, thanks to the AI theme, and also Brazil and South Africa, thanks to the commodity and precious metals theme. We believe that India will start participating in the emerging market flows. And that's why we believe that there should be an element of large caps also in the kind of funds that you want to go in from lump sum perspective. Saurabh, please do add your
Yeah.
points.
So yeah, Harshad, I completely agree that uh, even when you're choosing equity, the risk appetite for every equity category is very different. So like Harshad said, if the client has got a extremely high risk appetite and the money is there for 5 years, then of course momentum fund. And if the markets go up, there's a likelihood that momentum fund will be able to capture the upside movement the first amongst all the fund. Uh, the second fund for the high risk appetite is a small cap fund, right? Where you need 5 years kind of view plus. If you're looking at a diversified, we have multi and flexi cap fund. They both are diversified funds. That's the fund of the choice you look at, right? Mid cap comes somewhere in between. So broader category, I'm talking about the mainline fund. But also there's one more category for the investors who are very conservative but still want some equity participation. Then I would recommend a multi-asset allocation fund. Now, clearly, if you look at last 2 years, the multi-asset allocation fund returns have come in from movement of precious metal, gold, silver. Uh, but there's a likelihood of chance that next 2 years returns from multi-asset would come from equity, right? And with lower, volatility than a pure equity fund. So depending on the risk appetite of a client, that's the way you should be looking at the funds from Union Mutual Fund. Sanjay, follow-up question, since you manage all hybrid strategies and flexi cap fund directly, what's the view on gold and silver and how you are looking to manage the allocation in multi-asset?
Sure. Thanks. So gold and silver are bullion assets. They are scarcity assets, and as we have discussed in past, their price performance is actually linked to the demand and supply of gold and silver of the respective commodities. We believe that in the current geopolitical construct, we believe that the demand for gold and silver is going to increase over a period of time, mainly as a reserve currency or mainly as a safe currency rather than anything else. So even there is a good data on the World Gold Council where they do a lot of surveys with respect to how reserve banks, central banks are actually looking at these asset classes, and many of the central banks are looking to increase their allocation to gold over a period of time. So our view on gold is quite constructive. We believe that after COVID, actually allocation of central banks into gold as a asset class has increased substantially, and that trend is likely to continue. That's the thought on the gold. Silver remains a very tactical commodity because 60% of silver demand actually comes from industrial use. And as we have been telling in the Outlook presentation as well, the second order implications of this war are still unclear. Whether some of the developed economies may face significant challenges in growth and whether the industrial demand will take a dent for some period of time is something which is not yet clear. So on silver, it becomes very tactical call, and that's why there is no long-term view on the silver as of now. Tactically, we are positioned in silver to capture the upside in the silver in the immediate basis. On the gold, view is quite positive, and we are significant. We have significant allocation in multi-asset allocation fund in gold.
Okay. The next question is when we are looking at the current market, IT as a sector has corrected a lot. Is it a good time to buy lump sum in IT, or should we wait for some more time?
So, I would say IT is currently, there is a lot of debate that is happening in the investing world, not just in India, but I would say much more in the US and in developed countries, as to how the future of IT services is going to unfold given the rapid advances in artificial intelligence. In fact, it's because of the scare, I'm sure all of you know, because of this scare that we saw the massive correction in IT services stocks to start with. Whether we need an intermediary at all, that debate is still raging. Uh, we are also, sort of reading up, discussing with analysts, discussing with companies as to how this is. But I would say there is a great deal of uncertainty in the IT services space right now. As Sanjay correctly said that yes, the valuations of IT services companies have corrected a lot. The the which is true. What we are grappling with is whether AI is going to materially change the revenue and earnings growth trajectory of these companies in the future, in the medium term and long term. Uh, so that is still a debate. So I will not just get swayed. So the again answering the question directly, whether this is the time to go big on IT, I will caution against that stance, because valuations are looking attractive definitely. But remember, when we look at the valuations, it's primarily compared to the historical valuations, and the AI related developments is I would say a big thing that is happening in this sector. So I would caution against going the whole hog in terms of investing in IT specific funds. I think I would rather play it through diversified schemes, and let the fund manager change the portfolio weightages depending on, because the developments are happening very, very rapidly in this space.
So, Harshad, in other ways, you're also saying that typically when you are looking at IT as a high sector, high growth sector, if this actually comes true, then it may, the like, growth expectation may, itself may come down from IT sector, and the
Yeah,
valuation will justify the.
yes. So two things. I mean, IT services sector, clearly the growth rates have significantly come down, particularly if you look at the large IT services companies, look at their growth rates 10, 20 years ago versus now, because these are very, very large companies in terms of revenues. But your point is right, that we do believe, based on what we know now, is an in the short to medium term, the growth rates of these companies are likely to get impacted, because the productivity gains from AI will have to be passed on to the end customers. But there is also a hypothesis that from a medium term perspective, the growth rates will then recover, because ultimately, enterprises will need these IT services companies to implement the AI related advances. So it may be, growth getting negatively impacted in the shorter run, but recovering in the medium term. But there are lots of ifs and buts. So I will not take a very high conviction bet right now in IT.
Sorry, if I may just mention. So friends, also look at how IT sector is a global sector, right? And that's why, as Harshad is alluding, there are global implications of these developments which we have to assess. So you must have heard about Anthropic getting valuation of $800 billion plus, Grok coming for listing, or even OpenAI looking to list. I think over a period of over a period of next 2 3 years, at one point of time, this story, which is focused on hopes and the narrative, is likely to change toward profitability, and that is the angle which we are actually looking at. Because at some point of time, these companies which will come for listing will look at profitability, and at that point, we'll get the clear picture as to how quickly this AI will impact businesses. Because currently, because these are mostly unlisted companies, profitability is not clear, and that's why the exact implication on the financials is not yet known.
So, Sanjay, there's a question directly towards consumption fund. The question is that we don't see slowdown when we look around in discretionary spending. People are eating out, people are buying cars. But why has consumption theme not worked in last few months in India?
Sure. Uh, To see on the valuation side, because there was a de-rating on India's Nifty index as well, there were significant implications of that onto other areas, particularly on the consumption side, where some of the discretionary consumption companies were priced at much higher elevated level. Those valuations have also come off materially. And these are high growth companies in such kind of times, because the growth itself was doubted or come into question mark. There was a significant implication on the PE de-rating of these companies as well. So we believe that consumer discretionary is a fantastic thing over a period of time, and that's why we have been sitting overweight across our diversified products as well. But obviously, there will be phases like this when there would be some kind of correction in the consumer space. We believe current raw material inflation as well as question mark on the growth were the two main reasons why there was a de-rating in the consumption stocks as well.
So in our consumption fund, how much would be a discretionary portion, Sanjay?
So, Saurabh, we had articulated our framework, and we clearly mentioned that premiumization would be one of the big theme on the consumption over a period of time. And overall premiumization as a overall category, we are 55 to 60% allocation into the premiumization theme which we have.
And we are looking at it as a good sector or good place to be in for the next 3 to 5 years in India
Yes.
in terms of the returns outcome, right?
Absolutely, because we articulated the triggers. See, when market goes in panic or when such kind of shock happens, that is where the disallocation between the price and value appears to the fore. We believe that fundamental factors of GST cuts, indirect and direct tax benefits which government has given, and its pay potential, its pay commission which is likely to come in next year. Currently, market is discounting them substantially, and we believe that that is where the price disallocation is, that there is a big gap between the value and the potential value unlocking which can happen over a period of time.
Okay. Thanks, Harshad. If you can answer the next question, especially on BFSI, there's a huge correction in banks which have happened recently. Uh, do you think that these are at very attractive valuation, the BFSI sector, especially the banking side?
Yes, the huge correction happened, also because as we saw from FII perspective, there was massive selling.
Yeah.
And BFSI is one of the, big sectors, almost one third to 35-40% is BFSI. Yes, we believe that, banking sector valuations are looking reasonably attractive. What we need to factor in, though, is that the view on the rates, before the war and after the war, uh, has changed somewhat. And not just here in India, but globally. That expectation was that the rates, policy rates will fall further. Now the expectation is that they will probably not fall a lot because, the growth is likely to be a little slower. I'm talking about, globally, and inflation is likely to be a little higher than before the war. But yes, the answer to the question is that BFSI as a sector is looking good. Within that, we are more, we believe that there is more compelling valuations on the bank side rather than the NBFC side.
And we haven't seen the 10-year yield coming down while in last 1.5 year interest rates have been cut. Do you see yields coming down in next 1 year if the war is over, say in next few days? Do you see yields coming down? And also when you're talking about the yield coming down, how do you see inflation for next 2 to 3 years in India?
So, inflation, we believe, will be a little higher than before in India because inflation has behaved exceptionally well in India over the last 3-4 years. We didn't have inflation as a problem at all. And I think we can do with a little bit of higher inflation because that helps the nominal GDP growth to look better. So real GDP growth will improve, but nominal GDP, and that is, I think, one of the reasons. If you look at the earnings growth of corporate India, it is fairly strongly correlated to the changes in the nominal GDP growth. And one of the reasons why we believe that over the next 2 years we are going to see a better earnings growth outlook for corporate India is because nominal GDP growth, which was falling, is going to recover going forward. So we believe that inflation will be a little higher than before, but I don't think it will reach a level which is going to impede growth. That's our current call, and we clearly believe that in the yields in the month of March we discussed equities mainly, but clearly there was a lot of stress in the fixed income market also because there were fund outflows and things like that. We believe that when the war gets over, things will improve even in the fixed income markets. Although because of the actions taken by RBI, how quickly will foreign flows will resume in the fixed income market, we will have to wait and see, because the cost of hedging has gone up there.
Thanks, Arshad. I'll take up the next question. So the question is asked by a distribution partner that if there's a client 60-year-old and he's getting retirement money, what union mutual fund schemes should he consider? So before I answer that, it's not a fairly simple answer. You have to look at the client's total portfolio, how much money he has got in debt, how much money he has got in other, asset classes. Because typically after 60, you also need a regular income coming to you every year because you're not earning anymore, right? So rather than giving you a straight jacketed answer that, invest in hybrid or, equities, I think the first thing is to look at whether there's a source of regular income apart from this investment. So if he's looking for this investment as regular income, then he has to give it some time. So for example, if they're investing into the equity market, right? Not necessarily that equity market returns will be linear. So you have to stay invested in the fund for 2, 3 years and then probably look at some buffer building up and then start doing SWP. Otherwise, you start eating away your capital, right? So I would highly advise that when you're looking at a retirement fund corpus, the first question to answer is that is there a regular income available for him apart from this investment? If not, then investing into equity, you cannot be given a surety that every year you will be able to make 7, 8, or 9% and able to withdraw that money. Some years, then you will be eating away your capital. So typically, what I recommend, I repeat, that if there are other incomes, invest this money into like equity, right? Good valuation for 5 years, and the horizon should be 5 years, and then wait for the value to go up, and then some withdrawal can happen from here also. But you have to look at the portfolio in the entirely rather than looking at only investable surplus, right? Harsha, Sanjay, want to add anything over here?
Nothing from my side, sir.
You covered it well.
Okay. Sanjay, there's a comment that you have covered consumption fund. If, quickly you can give an update on the momentum fund, since we spoke about momentum as a highest risk reward strategy in in these markets, and followed by innovation fund. The innovation fund, the comment is that we understand innovation has not worked in last 6 to 9 months, the portfolio, but how do you see it playing out in next 3 to 5 years?
Sure. So both these funds are thematic products. So active momentum product is a actively managed and is focused on momentum strategy. This is a rule-based approach, and we have done good work with respect to backtesting of that product. We believe that momentum as a strategy is a fantastic strategy, and it has a different levers than the normal funds which we look at from the value unlocking perspective. It is focused on the momentum as a factor. So we believe that if investment horizon is more than 5 years, it's a fantastic asset class or a strategy to have in the portfolios. We are currently so there is a set. There are various set processes which are focused on active momentum strategy at Union Mutual Fund, and we rebalance the portfolio at least once in a quarter. So that is the way we are running the active momentum strategy. Innovation and opportunities fund is purely focused on innovations which are happening across the sectors, and that is a sector diversified sectorial portfolio which we run. We believe that strategy is also fantastic strategy from investors' point of view, because when there are a lot of innovations happening across sectors, and then there are certain companies or sectors which are getting disrupted as well, In this fund, particular focus is on the innovation happening across sectors, and that is where the allocation is getting into. These companies we have identified, which are part of our portfolio, are typically high growth companies, and majority of the portfolio is actually invested into mid cap and small cap. So that's why it will be high volatility portfolio, but it will also have the higher growth to back, and that is how this portfolio has been constructed. As the question itself understands that there were, let's say, questions on the growth in the recent past, and which has led to some kind of derating in these companies, which led to some volatility in the portfolios. But from the 3 to 5 years perspective, we believe that it's a fantastic product to have in the portfolio. But please be mindful that these are thematic products, have allocation accordingly in the portfolios.
Thanks, Sanjay. I'll take the next question. So I'm combining two questions. The one question is that, aren't we overly worried about the war, right? And when you're saying we, it means the, entire market. And why do we think the FIS will come back? I'll try to answer that, and Harsha, Sanjay, please add if you think I've missed out anything. So one comment is when we are overly worried about the war, markets don't behave in isolation. So even though war is not happening in India, there will be impact on the Indian market, what Sanjay Harsha talked about. And as investment managers, we have to look at the impact on the Indian equity market. The second question is why will FIs come back? First reason, the Indian market valuations are much cheaper than they were before. So when they were moving out from India, right, and they were going into other emerging market, what Harsha showed you in the earlier slide, at that point of time, other markets were cheaper than India. In last 1 year, those markets have rallied while India has come down, right? So India valuation wise has become comparatively cheaper, much cheaper than other emerging market. The second factor is, FIs are under allocated. We said all, in last 20, 30 years, we haven't seen this kind of under allocation to India. And the third factor is earning is looking to come back. So while earning was flattish in last 1 year, next 2 years, earning is looking to come back. So given a combination of all these three factors, if the war comes to an end sooner than later, there's a high probability that in next few quarters, you may see FIs coming back strongly in India. Harsha, Sanjay, anything that I missed out, feel free to add.
No, sure. We don't believe that we were overly worried because of war, because as I showed in the slide in the beginning, that the war that broke out at such a place that led to oil prices going up by 79%. And oil is I would say a non-discretionary import for India. Whatever the oil price, you have to import that. And that is the area of vulnerability for India. And that is something that we have always highlighted as a key risk. So when the war was on, I don't think we were overly worried about it. I think it was a negative event. And we saw what was the critical thing was duration. So if the war were to last, I know that the war is not yet over, but if the war, went on for some more time and the oil prices stay high for 6 months to a year, I think that will clearly be a big negative for India. But it appears at this point of time, and that is the reason why we are having this call now, is that there are many signs which suggest that we are probably past the worst. If the war resumes and intensifies, then clearly all the bets are off. But because we believe that probably the worst is over, which is why we are having this call now, that we believe that the panic reaction in the market has ensured that the value, as Saurabh said, the valuations are looking very compelling. Let me again reiterate that they have gone back to the average level on a 30-year average basis, but compared to 10-year average on a price to earning basis, there are 2 standard deviations below the mean. So, I would say quite compelling if your view is also that the worst of the war is over. I think we don't want to be mindlessly optimistic. Otherwise, we would have had this call in the month of March itself, while the war was still raging. The second question, sorry, what was the second question? Second part of the question, Saurabh?
Why would the FIs come back?
Yes, so FIIs, see, firstly, it's very important to recognize that FIIs have really come back to emerging markets as a whole only from 2025. There was a period of 3-4 years before that when we look at Indian flows and say that FIs haven't done anything. But if you look at global flows, FIs haven't really invested a lot of money in emerging markets prior to, I would say, April, May of 2025. FIIs started investing in a big way again only after the uh, uh, so-called Liberation Day in April 2025. What happened is bulk of that money went to markets like Korea and Taiwan because the hottest theme over the last 2 years in the global markets has been artificial intelligence. And in India, why India was left out is because in India there was no obvious AI play. A lot of the money went into Korea, Taiwan, and also if you look at the markets that did well last year, and also South Africa and Brazil. India was left out because there was no AI play, and also because I think foreigners developed a cold feet. If you actually go back and look at the flow numbers, if I recall correctly, May, June, July, or April, May, June, India did receive small inflows. But when US imposed 50% tariffs on India, I think FIIs really became very negative, which is why you saw money flowing into emerging markets but not into India. In our opinion, that will change because, again, the factors that Saurabh highlighted, earnings growth is picking up. The trade deal is done now, so India is not at a competitive disadvantage. And the consumption will start to improve. If you add to that, if you have a view that AI bubble is likely to start puncturing, that will actually be an additional plus for India because many global strategists are looking at India as an anti-AI play. We don't know whether that's going to happen, but if that happens, I think that will add to the relative attractiveness of India. And of course, as a starting point, as I said, if you look at the active fund managers globally, uh, they have not been so underweight on India, over the last 2 decades. So if that starts to correct, that will only correct when foreign money starts flowing into India.
Yeah,
Thanks,
just
Harshad.
one point
Yeah.
to mention. Also, one positive about India is very large domestic economy to back. So, as after this noise will be over, I'm sure people will reassess which are the large domestic economies and where the growth is going to come from. There would be implications of this war on the AI data center plays, as Harshad was mentioning as well, because at that time, if somebody is having large data centers in Middle East, they will also have the strategies as to now how to de-risk from that, and whether India will become now the next go-to area that we need to reassess. So those are the areas which FIs will also take into calculation when they are allocating capital over a period of time.
Thanks, Sanjay. Harshad, the next question is towards you. The long-term Sensex PE multiple post 2014-15 has been approximately 10 to 15% higher versus before that period. So if we break the period 14-15 and before and after 14-15, the PE multiple has been 10 to 15% higher. Why was this premium coming in the long-term PE, right? Especially after 14-15. And is there a risk that this premium will erode?
So yes, the market premiums also keep changing. It is never a constant, and many times it is not just the um, function of fundamentals. Uh, by that I mean earnings, but also function of flows. So I would argue that one of the reasons, not the only reason, one of the reasons why valuations over the last, I mean, I haven't checked the assertion that after 14-15, but I did mention that if you look at last 30-year average, uh, you know, uh, long-term average was 17.3, but if you look at last 10 years average is 21.8. So one of the reasons is clearly the flows. And over the last of 7-8 years at least, I would say that domestic investors' salience in our markets has gone up. So there is a durable demand for equities now from domestic investors. It probably started during demon, and it improved since then. It was also heartening to see in a month like March 2026, the Amphi numbers suggest that there was 40,000 crores of buying, and a lot of it was probably because of lump sum. So I would say that the advent or the growing salience of domestic investors is probably one of the reasons why the valuations are at a higher level. The valuations is always a combination of fundamentals. By that I mean, dividend, earnings, and also the flows. And prior to 2014, I'm sure probably everybody in the audience and Saurav, you will recall that the salience of domestic investors was not there. In fact, we
Correct.
had that painful period. Many of you will recall of markets in 2011, 12, 13 when nothing was happening. And I distinctly remember, and Saurav, probably you were doing the same, that my conversations at that time with distributors was not highlighting our funds, but highlighting equity as an asset class,
Correct.
right? So I
Yep.
think we have come a long way since then.
Thanks, Harshad. So there are some questions on scheme performance, which I'll take. So the gist of the question is that uh, for the next 3 to 5 years, should we look at Union Small Cap, or are there other schemes? And one question is, what scheme will perform best from our side in next 1 year? So I'll try to give you answers for that. So first of all, when you're looking at equity funds, and whether Union or any other fund, the first premise is, how are the valuations currently? And to sum up the call, we said that valuations are extremely, attractive. Earnings are looking to come back. There's an uncertainty. Now, you never get good prices and good news together, right? So whenever you are getting good valuations in the market, the news typically is very bad. Otherwise, market will not be cheap. That's the way of the market. Now, the only risk we are seeing in the market is that if the war continues for whatever reason, for next 3 months, 6 months, then again, your market going up may be delayed, but it doesn't look like it looks like beginning of an end. Now, coming to Union Mutual Fund, so once we established that equity is a good time to enter, right? From a valuation perspective, we showed you the shorter term, the flows. We also showed you fair value, which showed the markets are extremely attractive. And just to give you information, that fair value is 5 year view, but the last time it came at very attractive was COVID time, right? So it didn't come during the time. Mostly that fair value is at either fair value or slight premium, as Indian markets are. So there are very few, I would say 8% chances when you get market extremely attractive from a long-term perspective also. Now, when you're looking at Union Mutual Fund, yes, small cap fund is doing extremely well. That's why a lot of interest is coming over there. But I would, if I were in your place, I would take exposure in 3 to 4 funds of different styles. Not necessarily, that you look at the fund which is only on an absolute ranking. What we look at Union Mutual Fund is the consistency of the fund. Ninad, can you share that PPT? So I'll just take 2 minutes with you just to tell you how we look at our own funds, right? So first of all, the fund manager, objective is to be consistently try to be in quartile one or quartile two. So when I say quartile one, quartile two in the respective category, if there are 40 funds, the top 20 fund will be either Q1, Q2. Q1 will be 1 to 10 and Q2 will be 11 to 20. So if you are consistently in Q1 or Q2, automatically the track record of the fund is extremely good after that. So currently, if you look at it, for a 1 year period, we have got two schemes which are in quartile one, the small cap fund and the focused fund. This data is as on 31st of March. We have got 8 schemes in quartile two, right? Which is a multi-cap fund, large mid, value fund, mid-cap fund, business cycle fund, retirement and children fund. Out of this, there are 4 schemes which are inching towards Q1 because of being consistently in Q2, which are multi-cap, value, mid-cap, and business cycle fund. Now, typically, if you look at it, any scheme you pick up which have been Q1, Q2, your outcomes are good. My request to you is that when you're looking at Union Mutual Fund, please take exposure in 3 to 4 schemes, right? So you get a flavor. And we also at Union Mutual Fund, we have a multi-fund manager strategy. So while Harshal manages 2 funds directly, which is the multi-cap and the business cycle fund, Sanjay, while he's a like head of equity, he's managing flexi cap and all the hybrid strategy. Apart from these two, we have Gaurav, Prateek, and we also have Vinod, right? So every fund manager has got 3 to 4 funds to manage, right? And the styles are very different. So one thing which has which is very unique about our fund house, while we have a robust investment process, it's not prescriptive by nature, right? There are guidelines for the process, but fund manager has got enough independence, enough thinking to build up his own portfolio, right? And the styles can be very different. So, which is what I'm saying when you're looking at Union Mutual Fund, yeah, you should look at right now, like I said, for next 5 years in the mainline fund, should look at small cap, mid cap, flexi and multi as a category. And in hybrid, you should look at multi-asset as a category. And if someone is really looking at a higher risk, then momentum is one what we are looking at a higher, highest risk and reward strategy. Can you go ahead in that? The second objective of the fund manager is also to beat the benchmark because that is what we are charging the the investor for. So if you look at it, most of our funds, apart from few of them, have been able to beat the benchmark, and the ones which have not been able to beat the benchmark, right, are not very deviating from the benchmark. So when you look at the active momentum fund, it's not the right index, Nifty 500. The actual index to be compared should be the momentum index, right? But due to the benchmark issues, we had to write Nifty 500 over there. So most of the funds have been able to beat the benchmark. So the last column you see is how much alpha we have generated over the 1 year over the benchmark. Go on the next one. And when you look at how we look at our funds, so we look at our funds, how they are doing consistently is if they are green and blue, they are either in Q1 and Q2. And the effort is to make sure that across shorter periods also we try to be Q1, Q2. We will fall in Q3, Q4, but the idea is to come back in Q1 and Q2 quickly. That's it now. Thank you. So when you talk about the performance from Union Mutual Fund, I would recommend the mainline funds what I've told you, flexi cap, multi cap, mid cap, small cap, and multi asset as a hybrid strategy, and momentum if you're looking for high risk reward ratio. Consumption fund remains to be a strong theme for us across all our portfolio. We are overweight on consumption as a theme. So over the long period, yeah, consumption fund also looks good. Now, just to recap it, we have said that this is a good time for people to enter market. STP of 3 months. If the war gets over in next 1 week, you can prepone the STP, right? Then you can go all in at that point of time. But like we said in the beginning of the call, the biggest risk in the equity market right now is to be under allocated to equity market. Sanjay, Harshad, anything which I missed out in recapping the whole?
No, you covered it well.
No,
Sorry.
Saurabh, you covered it well, and that was the best one message if we want to leave with people is what you said towards the end.
Yeah. Okay. Thank you everyone for joining in the call. Yeah, we will share the presentation with you on the as a link on your email ID registered with Amphi. Thank you.
Thank you.
Thank you.